Jai Hind dosto, welcome to Finvision. I'm Colonel Sandeep Mahalwar, and in continuation with our series of financial awareness videos, today we have come up with another important aspect, that is which tax regime is beneficial for you, which one should you be choosing, and how should you go about it. Today we will give you a detailed decision matrix for you to select the right tax regime for you. Firstly, coming to the key income tax changes that have been announced in this budget and that impacts you. Firstly, new income tax regime will be the default tax regime with effect this financial year. The old tax regime does allow few deductions and exemptions, but since it has got higher tax rates, which may lead you to higher tax liability, hence one need to choose it accordingly. The tax slabs in the new tax regime have now been changed. Here are the tax slabs in the old tax regime, wherein if the income is from 0 to 2.5 lakhs, there will be nil tax liability. From 2.5 lakhs to 5 lakhs income group, the tax liability is 5%. From 5 to 10 lakh rupees of income, tax slab is 20%. For any income beyond 10 lakhs, the tax slab is 30%. The new income tax regime tax slabs are here up to 3 lakhs of income is tax free, 3 to 6 lakhs is taxed at 5%, 6 to 9 lakhs is taxed at 10%, 9 to 12 lakhs it is taxed at 15%, 12 to 15 at 20%, and the income beyond 15 lakhs is taxed at 30%. There have been no changes in the deductions and exemptions of the old tax regime. However, there are few deductions and exemptions which are now being allowed in the new tax regime also. What are these and how do they compare with the old tax regime? Let's look. So, firstly, rebate eligibility. Income level for rebate eligibility in the old tax regime, it is up to 5 lakh rupees. That means up to 5 lakh rupees of income in the old tax regime will continue to be tax free. In the new tax regime, this limit is 7 lakh rupees. Though the tax-free income in the old tax regime is only up to 2.5 lakhs and 3 lakhs in the new tax regime, but because of the rebate that is allowed of 12,500 rupees in the old tax regime and 25,000 in the new tax regime, the tax liability up to 7 lakhs becomes nil in the new tax regime and up to 5 lakhs in the old tax regime. Also, the standard deduction of 50,000 rupees is now eligible in the old tax regime as well as in the new tax regime. Therefore, effectively, in case your income is up to 5.5 lakh rupees, so you can choose the old tax regime and pay nil tax. In the new tax regime, income up to 7.5 lakhs is tax free. In addition to this, your various benefits are also allowed in the new tax regime. And the prominent among those are your PMR voluntary retirement benefits that includes your gratuity, leave encashment continue to be tax free in both the regimes. Home loan interest for the let out property under section 24 Bravo continues to be tax free even in the new tax regime. Your TA, DA and other allowances which come as tax free will be allowed even in the new tax regime. So which tax regime is beneficial for you and which one should you choose? For this, now you need to calculate your break-even threshold for the savings and deductions. Like what is this break-even threshold? This is the minimum exemption and deduction amount that you need to have on annual basis for the old tax regime to be beneficial. In case your total deduction and exemptions which are allowed are less than this break-even threshold, then you should be choosing the new one. Otherwise, if there are more than the break-even threshold, then the old one would be beneficial for you. Coming to the commonly applicable exemption and deductions for the armed forces personnel and the salaried class taxpayers, we in armed forces are eligible for, that is standard deduction, which is of 50,000. Home loan interest, maximum of up to 2 lakh rupees. Home loan interest, a maximum of up to 2 lakh rupees is allowed. Under ATC, that includes your DSOP, PF, insurance policies, etc., up to 1.5 lakh rupees, NPS of up to 50,000 rupees, health insurance based on your eligibility up to maximum of 75,000 rupees, and education loan interest as applicable on individual basis. So under these heads, you need to calculate what is your aggregate amount of deduction and exemption that you will be taking in the entire year. If the amount of those deduction and exemptions is greater than the break-even threshold required for your annual income, then select the old one. Otherwise, new one should be the option. We will come to the threshold on income basis in the next. So here is the table which lays down the break-even threshold required. Firstly, in case income is only up to 7.5 lakh rupees, you can straight away opt for the new tax regime and pay nil tax. If your income is 10 lakh rupees and your savings under deduction and exemptions, which are allowed in the old tax regime, are, if in case they are more than 2.83 lakhs, then you should be choosing the old one. Otherwise, a new tax regime will be beneficial. For the income of 15 lakh rupees, that is the newly commissioned officers generally come in this category. In case your deduction and exemptions, including in your DSOP, home loan interest, in case you have, and other deductions allowed, in case the amount is more than 3.58 lakh rupees, you should be choosing the old one. Otherwise, new one should be the option. For 20 lakhs of annual income, the break-even threshold is 3.75 lakhs, and this continues even for the 50 lakhs rupees of annual income. Therefore, for majority of the officers, in case your deduction and exemptions under your DSOP, home loan interest, health insurance in case you have it, in case the total aggregate is more than 3.75 lakh rupees in the annual basis, then select the old tax regime. Otherwise, a new one should be the option. So what are you supposed to do? Based on your annual salary package, based on the slab that you fit into based on the annual income, here is one calculation. When gross total income is 25 lakh rupees, in case your total amount of deduction and exemption is more than 3.75 lakh rupees, go for the old one. Otherwise, choose the new tax regime, which shall make you pay less in taxes. Here is one consolidated table which tells you, in case your deduction and exemptions is more than the amount indicated, choose the old one. Otherwise, new tax regime should be the option. Now, how to exercise this tax regime option? Firstly, selection has to be made. Otherwise, your employer, that is your CDA, and the salary paying agency will make you pay the taxes as per the new tax regime, and they will accordingly deduct the amount as per the new tax regime, because that is the default regime from now onwards. Therefore, make a choice based on your specific situation in the source of income and the amount of income that you are likely to have in the entire financial year. In case your income is only from salary, you are at an advantage wherein your selection can be on yearly basis, and it can change from one year to the another year. But you need to inform the employer about your preferred tax regime in the beginning, and most of you must have got a message from CDA for opting to a tax regime. So do your calculation and inform them immediately. You may choose any one of those which, as per your calculations, comes beneficial, and you always have an option to change it at the time of filing of ITR. And from this year onward, you should compulsorily ask your CA at the time of ITR filing to give you a comparison between the tax liabilities in the new tax regime and the old regime, and wherever and whichever is beneficial for you, you should choose one. The things become a little complicated in case you have income that includes income from the business and profession. Herein, new tax regime is the regime that will be applicable to you. In case you want to opt for the old tax regime, you need to file the form 101E to opt for the old tax regime. Also, in this case, once you exercise your option to opt for the new tax regime, then that tax regime should apply for subsequent years. In the entire life, you will be given only one option to fall back to the old tax regime. So this is what you should note. And this in the armed forces and the salaried class will be applicable for the people who have income from the future and options and daily trading, etc. activities, because that income is normally taken as a business income. Now, here are some income tax changes that impact your investments. Number one, with effect 1st April this year, the indexation benefit from the mutual fund has been taken away. And this is affecting not only your debt fund investment, but also all your funds which have equity exposure of less than 35%. So what should you do? Immediate action should be compulsorily check your portfolios. In case you need professional help, you can contact us, or you check it yourself, and must realign your investment now to avoid losses later. Now, the insurance policies, in case your premium on the annual basis is more than 5 lakh rupees, the maturity benefit that you get at the end of the policy will be taxed from now onwards. For ULIPs, this limit is already at 2.5 lakh rupees. So action is must avoid such policies. For non-government employees, the tax exemption limit on leave encashment has been hiked, and this is a win-win situation for them. Now, international investing. In case you are investing abroad under the LRS scheme, you should note that TDS from now onwards will be 20% in place of 5%, which used to be till now. So what is the action required? Reconsider your global investing. And as such, India has been performing better. Indian markets have been performing better, and India has still got a better potential than the global markets. Also, from the budget, it appears that the government is very clear, and after a few years, new tax regime should be the norm, and all the benefits related to the old tax regime should be going off very soon. Therefore, action required is don't commit huge amounts in the tax saving investment, like don't unnecessarily take a home loan to save tax. Don't invest into insurance policies just to save tax and it allows you tax saving, because after a few years, you may find it these benefits have been taken away and you unnecessarily had to pay for the commitment that you make now. Therefore, you need to reconsider such investments. I'm sure you will find the video beneficial and it will help you in selecting the right tax regime and informing your employer in time. Don't forget to subscribe, like, and share our channel. And till our next video, thank you and wish you all the best.